All right. Um, 5 minutes to the news release. I just quickly gobbled down some M&Ms. Super starving. It is almost 2 a.m. here. GMT plus 8. Almost 2 a.m. here. So if you're on the session, do drop a message. Say hi. Let's keep this a little bit active, just so I stay awake. Um, yeah. So if you're on the session, drop a message, say hi, let me know that you're here. If you're not a regular like Diana and Hungry Foodie, good to see you guys on the session. If you're not regular, drop a message and let me know where you're joining us from. Any questions, put into the chat. Let me know. Don't forget to click that like and subscribe button as well. That thumbs up does help somehow. All right. Um, so yes, today we are awaiting. Diana said, "Very interesting to see you at night." Yeah, it's early morning. It's early morning. So we're 4 minutes. We're 4 minutes away, awaiting the Fed Reserve, the U.S. Federal Reserve's decision on the interest rates. Most likely, almost definitely, going to stay at a 4.5%. And we'll see an initial reaction. We'll see an initial reaction, and then after that, um, I'll try. I think I can figure it out to play the press conference as well. It is 10 a.m. It is 10 a.m. in Dubai. That's another reason why I feel like I have to be there. Um, it's good for football. It's good for the FOMC. Mm, you know, no big stress. I imagine I have to watch if I want to watch the Champions League or the Europa League. It's 3 a.m. for me. I have to stay up to 3 and then watch for 2 hours till 5 a.m. Or it could be 11 to 2 or 1. So yeah, definitely a place to be. I'm so jealous. Okay, let's do the next part. That one. Okay. I'm trusting that you guys can see me and hear me okay. All right. So everything's working fine. I'm trying new layouts and all kinds of fun new things as well. So let me know if you like this new layout as well. All right. Okay. And we have, and if you scroll up to the top, we have a new um, Elite Navigator. Check out the links in the descriptions. If you haven't already, try Pepperstone, the brokerage. The link is there. Help me out. Click on the link, sign up for an account. What else? I forgot. Get onto the mailing list if you haven't already. And if you're not an Elite Navigator, sign up and be an Elite Navigator. Sorry, I was just rambling while I was looking for my mouse. Okay, for my mouse, let's go. It is 2 minutes to the news. We have the news here. We have the news here. Fed funds rate 1 minute now actually um, keeping at 4.5%. No big surprise expected there. We'll look into the statement as well. All right, we'll look into the statement, and then at 2:30 a.m. we'll have the press conference. I'm hoping it's going to bring about some volatility. The dollar, I'll zoom in here. Right, the dollar has done that first part, so it hasn't. I'll just clean up the charts a little bit. Um, it's pretty much set across and pushed up. So this was what we're talking about this afternoon, that it was going to sit across, push up, and then ideally push back down with that dollar weakness or resumption of that dollar weakness, right? So it came up to 99.60, which we talked about. Maybe a spike and then a test and then a retrace back down or continuation back down. That's something to look out for. 3 o'clock now, so the news would have been released at 4.5%. No big surprise. The dollar is a little bit undecided, right? It's gonna, I don't think it's gonna push up and then after that turn back down. It needs to get to a level first. So it's deciding. Let's have a look at the statement. It's not a big rush thing today. We definitely would have seen more exciting FOMC days or FOMC mornings. It's not out yet. There we go. No, it's not out yet. We definitely would have seen more exciting days and mornings. This, typically at 2 a.m. on a big, on a more contentious FOMC session, it would be spiking already, right? So at this point, nothing so far. Let's open a couple more charts just so that I don't have to change that one. Let's see. Now that one, okay, the statement is there. So let's have a look at that. Go back to that one. Let's go to the statement then. I don't know why it doesn't always. Inflation remains somewhat elevated. Uncertainty about outlook has increased further. Looks like it's more reason to keep it at the current rates for a little bit longer. All right, so I'm going to be clicking around a lot. What's this? I'm going to be clicking and scrolling through charts a lot, so just bear with me on that. A dollar pushed up, now pushing back down. In this area, for me, in this area here, just highlight that. I'm not so convinced on anything to do, right? Yes, I want to see it push down, but I'll be more happy to start taking action from that move lower. Okay, so this is still waiting for a little bit of a confirmation in the way I look at it. Looking at the statement, although swings in net export, yes, we know that unemployment rate has stabilized. We saw that from the non-farm payrolls. Labor market conditions remain solid. Inflation remains somewhat elevated. Yes, it's actually not that elevated, but it's just not as low as they would like. Keeping rates on hold will assess incoming data, evolving markets to achieve its target. Yes. So it's a very short statement. The first thing to note is that it's a very short statement, highlighting very easily on exports and just touching on that tariff issue, mainly saying that inflation is not there yet. There's a lot of uncertainty on the outlook, and because of that, they're going to take into considerations with all the stuff before they jump into the next decision. And that's what we're seeing, that reaction, a very muted, a rather muted reaction on the dollar index for now. Hey Jamilu, how are you doing? Good to see you on the session. Right. So what I'm seeing here is the dollar. I'm even checking to see whether I've got internet. I'm not disconnected. Right. The dollar is sitting there. It's tested 99.60 like we anticipated. And then now I'm looking for it to drive down towards 98.90. Scrolling through, and hey, if you got any currency pairs that you'd like me to look at, do let me know. All right, I'm just trying. Okay, that's today. Okay, I'll just keep that prepared for now. Okay, so I got my other screen here. We're going to watch the press conference later on. All right. So if you have any currency pairs you'd like me to look at, anything else you'd like me to look at, put into chat. Let me know. Kiwi dollar push down, not as low as I would have expected before now looking like turning back up. That's we can take away. That we can take away for now. Because the dollar is trying to push down, I would think that this might be the point, right? And this will be trades that I'm looking at right now. So I got my MT4 open, MT4 and MT5 open as well. So this will be trades that I'll be looking at where I might even be thinking of that, where it clears back from there. Hang on, let me check that. So very seldom we get a chance to do this kind of planning. Actually, I'll just do it up here. Because usually right after the news gets released, it just spikes and pushes all over the place, right? So very seldom we get to do this, to wait for the reaction and then after that decide. That's probably something to look at. 5995, 40 pips up, 15 tight stop loss here. We could look at that. Diana says US yen kind of bearish flag because of the dollar pushing down. So that didn't trigger. We'll take that one away. Bearish flags. I'll take that one away for now first. And we don't need that one first, right? So we have that heading down, and then after that, oops, something like that pushing. So that's what we're looking at on the yen. So that's not going to push up, and you can see it really struggled to push any higher. It's coming back down. It's still reasonable. It's near the start of the hour. The dollar is gaining a bit of that strength or that weakness to the downside. Good spot there. Nice spotting of that move. I'm actually thinking of that point, 142.85. Right, so the super safe option would be to let it break that point. But I think that there is a reasonable amount of space in between, right? So you could actually, if you look at this on the 15 time frame, that could be, I think you can look at that point, right? For it to break there, come down to about there, you have about 80 pips. You can do a 40 there, that way, right? The only thing is that because it is outside of the Bollinger, it might come back in a little bit. But because of this having that strength, I think that the dollar yen could push down strongly, a bit more strongly before it retraces slightly. So you could be looking at that on the dollar yen. I would like, technically I would like it to do that and then that, right? So then you get a chance to be looking, then you get a chance to be looking at about 142.90. Let it retrace and you go 40 to 80 to the downside, being that point there. Okay, so it is retracing right now, so that's why you want to wait. You want to give it a chance to retrace back into the Bollinger. Don't rush into it. So I want to see. I see that down already. Oh, you see that come down. You want it to retrace and then push lower. Then you'll be looking at 142.90. So we looked at the Kiwi. I'll go to the 15. It's not ready yet. I think Kiwi is not ready yet. In here, it can still test and push back. So I wanted to clear that point. I'll keep that idea. I'm not going to type it up. I'll keep that. We can just talk through it. Aussie dollar looks a bit odd, right? The dollar is pushing down, which should show the Aussie dollar push back up, but it's still showing a little bit of that rejection or resistance to the upside. It might sit across, then push up. I don't actually like the Aussie that much at this point. I think that even if it does sit across and then push up, it's going to be a weak one before it comes back down again. The better move on the Aussie, or to look out for on the Aussie, would be if it sits across, pushes down, and then we look for that bounce back up. Maybe not as low, maybe around to that point. Right, so not super keen. Kiwi maybe a bit later. It is trying to push. There is the alignment in price action. Could look to push up, not ready yet. Aussie is sitting there. I don't like it as much. I don't think it's ready. I don't think it'll be a good entry point. So not keen. How's the yen doing? Yen is still trying down on a 15-minute time frame. Right, so retracing pound dollar. It's interesting here. So okay, we're not likely to see that dollar strength, right? We thought of pound dollar on the dollar strength where it could push down. Now let's think about the pound dollar sitting at this point here, right? Like that, like that. If you look at an H1 time frame, finding a little bit of that support there, maybe sitting across and then pushing back up. So we're kind of looking for this kind of move back up on the pound dollar, which needs a little bit of time, to play out. That's why I don't think today is a super. It's been very priced in. It's been very much anticipated and priced in that they're not going to do anything, that they're going to wait, they're going to be cautious. So there's not a huge volatility there. That's what you look out for, right? You got 40, you got 50, you got 70 up to this point. And it's sitting across. The dollar, look at it. The dollar is trying to hit lower, but yet we're seeing, well, Kiwi is sitting there. Aussie is trying to go lower. So it's going against that dollar weakness, that slight dollar weakness that's happening. And it's retracing right now. So pound dollar is pushing back down. Right? So this is where you should be, and this is okay, this is where like back in the day, I would have rushed into a trade. Right? I would say, oh, it's dropping. No, dollar is dropping, but pound dollar is dropping. So let's try and sell it down, and then after that, buy it back up and do all kinds of stuff. But slightly older, slightly wiser. Now the thought is, the thinking process is that okay, dollar is dropping, which should show me pound dollar climbing up, right? Cleared out that one. So dollar is pushing down, which should show me that pound dollar should be pushing up, but yet it's pushing down. This is where you sit out and go, it doesn't align with the expectation. It's not showing me what I want to, or what I should be seeing. You shouldn't get into a trade, right? So pound dollar, nothing yet. Basically, no trades yet. I think it's about 15 minutes to the decision. I see something, some music playing. Okay, it's 15 minutes to the press conference, so I don't think it's I think the volatility is waiting for that. The euro dollar looks quite good, right? So it's done that, but to a lesser extent, where now the euro dollar is pushing up as the dollar index is pushing down. So you're looking at this, it should align with what you are looking for. So in this case, if we look at that, you can think of, hey, if the dollar is going to continue to weaken, then 1.1390, I can have a relatively tight stop at 20. I can have a relatively good take profit at 65, towards at 61.8 on that dollar weakness scenario. So you would like, that would be quite high on the ranking. US yen is still sitting on, let me have a look at this on the 15. Yeah, that's still reasonable. US yen on the 15, it's retraced, it's going to sit there. Let's retrace to that point, may then push back down. Dollar index is sitting right across. Okay. All right. Then, again, not too exciting. Euro yen, I don't really look at euro, at cross pairs. Pound yen spiked right down. So we talked about that point, right? So we talked about pound yen this afternoon, where, you know, it could push up, but you want to watch it because that's that level that it could hesitate at. And it did exactly that. It paused there and pushed right back down. So let's take those away just to clean up the charts a little bit. US CAD, yep, we're getting to that. US Swiss franc is pushing down. Retracing, so it came right off the Bollinger, pushing back in because dollar index is also tracing back in a little bit. So what you're looking for here, you got 12 minutes to the press conference. What you're looking for here is possibly that kind of move back down, right? A retrace and then a push back down. That's why, like when I was telling you, that's where this area is where I'm not going to do anything. It's not confirmed on that downside yet. It's still trying to find that move. So we're going to wait for that to play out. Then on the US CAD, we didn't have that big drop. We didn't have that big drop on the CAD. Now it's pushing back up, which again doesn't make that much sense because it's resisted that dollar move, right? It's resisted the dollar's weakness, and it's pushing back up. Why I zoomed out is I'm looking at that whole trend line pushing it lower, which might work out that way. Which might work out to this point where, hey, maybe the CAD or the Loonie might do that. So it's pushing up now. I wouldn't be looking at it because it's going against what I think. But I'm thinking that maybe we see that dollar weakness come back into play. We could look for a rejection of 1.3820 to push back down. Gold is just sitting right across. As undecided as the dollar is, gold is mimicking that and sitting right across. It doesn't look like, see, everything is going towards that downside. It's a bit odd, a bit odd. It feels like this is the right after the news it's dropped, or right on the news it's dropped. It's gonna retrace slowly. Hopefully we hear a bit of a dovish or more concerned Chair Powell, and then he'll push it back down again. Right? So that's what I'll be looking out for. That actually, the US yen actually looked really good. The US yen actually looked really good for a while until it, as we expected, was out of the Bollinger and had to come back in. So that's what we're waiting for. We've got 9 minutes. So when it comes to the news, where am I? Okay, when it comes to the news, I want to make sure that this works. We'll jump over to this. All right. While we are gonna jump over to this, let me just try something. Okay, kind of figure out what's the music then. All right. So once the press conference starts, we'll jump over to this where we can watch the press conference together. If there's anything interesting on the charts happening, then I can jump back to the charts with you guys. Okay. It is 8 minutes to the start of the press conference. Grab a drink. I don't think it's going to be super exciting, but grab a drink. Keep hydrated. If you're on the session, do drop a message. Say hi. Let me know that you're here. Remember to click that like, that thumbs up button if you haven't already, and the subscribe button. And for the Elite Navigators, those who are not Elite Navigators, click on it and join us as an Elite Navigator. The links are all in the description below, especially the mailing list as well, to join the mailing list. Okay. Yeah, super uneventful. If during the press conference it's going to be relatively uneventful as well, then hey, beauty sleep calls. Okay, still works. Okay, where's my mouse? Okay. All right. 6 minutes to the news. The dollar is still tracing back. That's on the 15-minute time frame. On the 5, why is this here? On the 5, it's trying. On the 1, it looks like that was before the news. It came back to that about 50%, and it might push back down. What time was this one? Yeah, so that's on the news drop all the way down. It came back to that 50, and then now it looks like it's trying to push, reject the 50, cross over to the downside, and push back down again. So we're going to wait a little bit more to see that come back down. I do want to see it push down. to the downside. How many times can I say down? Everything else is not doing anything. Let me try and zoom it in a little bit more. Can we see that a bit better? Yeah, I think that would be good. Okay. That might work better. Okay. Pound dollar sitting at a level. Diana is asking, do you think India-Pakistan attack can potentially cause some fear for investors and interest in gold? I'm not super full bottled on it, but from what I've heard, from what I've understood over time or learned and read over time, the border, the India-Pakistan border, has always been an ongoing conflict. It's been an ongoing conflict. It certainly has escalated a lot more this time round, it seems. But it's been an ongoing conflict. I don't, and because it's only, sorry to say, but it's only India and Pakistan. It's not the US. It's not Russia or like the major parties. There's no doesn't seem to be a quick or big flight towards reserve. So I don't think that it will drive a big move towards, or rather, we have not right now. We have not even seen that big move towards reserve on gold. So I don't think and the move towards reserve on gold is usually quite immediate when the big news comes out. It happens almost straight away. Hasn't happened this time around. So I don't think it factors in that much. But that's a good thought. That's a good thing to consider as well. 2 minutes to the news. Now let me know if you can hear anything. Do you hear a background music, background sound music? That's kind of 50-50. Tech in China. I think it's more the China-US tariff. The maybe not so much the China-US tariff. I think it's more the US tariff potentially causing that what that recession and possibly global recession and overall global economic uncertainty. So I don't think it's just between China and the US. It's just how it's going to on a global scale. That's why we see that move towards reserve. Some music of sort. Yes, okay, good. So that music is the holding and waiting music that we would see on the press conference. Is that it? Oh, better. Yeah, so we're just waiting for the press conference to get started. I think it's in 1 minute time. Right? And I'm still looking at the charts. Hasn't done too much yet either. Dollars bounced back a little bit. Right after I said that, it's come back down slightly again. So it's still sitting, it's dropped, retraced to that 50 and sitting across. Okay, now we're waiting for Powell to come out and start talking. I used to even do sessions like this in person. So we'll book out a hotel conference room and then Everyone was sit around until 2 a.m., 3 a.m. and trade together. We did events in Bali where we traded all together. We booked our villa and all traded together. All right, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective.
So it's just reading a statement now.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
As he's talking,
I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment.
Can you still hear the press conference?
In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and
seeing
price
the dollar
stability
weaken back
mandates,
down now.
keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons
has
over
only
which
helped,
those respective
Aussie and
gaps would
Kiwi.
be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping
still waiting
longer-term
for.
inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go.
Steve.
We expect the volatility now.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape.
Dollar
And
index
our
is,
policy is sort of
the DXY
modestly
is
or
sinking.
moderately restrictive.
waiting for it
It's
to
100 basis points less
break the
restrictive than it
levels.
was
Still in the
last
undecided
fall.
or
And so we think that leaves us in a good place to wait and see.
Thinking
We
point.
don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmermans of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is is good. It's what you see, which is inflation now
Aussie
running a
looks
bit
like it's
above 2%. And we've had
possibly getting
basically
there. I just
decent
don't like it
readings
the
in
current
housing
time
services
frame.
and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know.
Maybe the
I
close
think,
there.
and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see
Just
further
one quick
are
trade there, but
are
wait
fairly
a little
low,
bit
we
more.
think. So that's what we're doing. And, we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land.
TV is going to take a long
And we'll
time.
know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve.
If you're making
We don't
trick him
feel like we need to
into
be in a
saying
hurry.
June
We
is a
feel
cut.
like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments
Super
play
nice.
out,
Look at that.
and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
John L.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks
Totally, yeah,
likely,
totally covered.
given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. We might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move
I
preemptively.
don't
Now we
think
have
it's,
inflation
stronger
running above
dollar. I
target.
think
It
it's
has
just
been above target for
directions
4
the one he's
years.
talking about.
It's not so far above target now. And we have an expectation, conditional on
He's
what
trying to make
happens,
it sound like-
that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting
implication
an
is
increase
that
in inflation.
rates
So
might stay higher
it makes
for
it, and then
longer.
we've also got
And that's why we see that
forecasts of
dollar
weakening
strength coming back
in the
into
economy, and
slight
some
dollar
have
strength
recession
coming back into play.
forecasts. We don't publish a forecast about that. We don't publish a forecast that
saying also
assesses
that
how likely a recession is. But in
If
any
they need
case,
to cut, they can do
it's
it
not a
quickly.
situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby.
it stays within this level, I'm still
Colby Smith
okay.
with the New York
Still
Times.
quite keen
How
on
much
it.
weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
You know, so first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well, participation, I
That's
mentioned,
breaking.
at a good level. So, you know, with the labor market, we would look at the totality of the
out.
data. We'd look at the
Look at that.
level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the
Very
whole
odd.
huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice?
Break
I mean,
the
how much of
black
that
line,
assessment will be rooted
go
in a
towards
forecast
100.
versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a
Probably.
complicated and
I feel
challenging
like-
judgment that we would have to
Yeah,
make.
let's mute that.
Yeah, and
I feel like it might, if it closes like that, because we talked about this level, right? So if it closes like that, it might, because it's outside Bollinger, it might come right back in. So we need to see what happens in this area still. If it breaks the black line, I hope it breaks it by a lot so that it has to retrace back in. If it closes like that, I feel like the retrace might also be a little bit weaker.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
you know, it's going to depend. I think you
Should
have
the
to
Fed
just
Reserve
take a
cut
step
rates at
back
all this year?
and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to
And
settle
Trump
out
just said that
and what
he
the
won't
economic implications
lower
are for employment,
tariffs
for-
on
and
China to start trade talks.
inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And usually things clarify and that the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the
Hungry
economy.
foodie. So
Well, let me press you on this idea of the economy
popped up.
being fine right now,
Maybe
because
you
reading the
come back
Beige
here.
Book very closely the last time around, there was a lot of, negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself, that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues, nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months.
Even
And
a
that may
press
be what
conference
happens,
is a
but
bit
it hadn't
of a
happened yet.
letdown.
And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. I would say this: we did things.
Remember
Essentially,
that
we're on an emergency
tomorrow
footing
we
for
do have
a couple of
the
years in the
BOE,
pandemic, and
the
it's
rate
very
freeze
fair and very
from-
welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we,
Could be
of course,
looking at
tapered and
bonds,
everything.
QE.
And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered
that's
earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action
very undecided.
kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that you know we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And you know, we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And you know, the risk is if you go for things that are really not on your mandate, you know, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. You know, what we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, you know, wanted to hear it that way, but that's not at all what we meant. So that's just not a correct reading of our, but I can see how, you know, maybe people found that confusing, and you know, we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about the, you know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so you know, we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there would be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Is his job secure?
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, you know, what kind of interest rate decisions you will make later this year. So does that, you know, in March, there was guidance that 2 cuts might happen. You know, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
You know, we don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And you know, we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So that's going to be potentially a very difficult judgment.
With me on this session.
But the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other.
But it doesn't seem like it's going to be now. It looks like it might be after he finishes his talk or his press conference. Then we might see some movements, but it's a little bit too late then.
The debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path.
We are seeing
and it's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Still in that area.
Or do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risk to the labor market. At the same time,